Welcome to this interview practice session, where today we'll take a look at some questions and model answers focused on the Accounting Principles and Procedures competency. This competency falls under the RICS mandatory competencies and is applicable to all pathways, and the following questions and model answers are really designed to cover this area in detail to help candidates feel better prepared for their final assessment interview. So without further ado, let's go straight into the Q&A practice. And the first question we'll take a look at under this competency is please explain your understanding of the term tax depreciation. And to address this, we can say that tax depreciation is where the declining value of an asset is offset against the company's taxable profit. The depreciation in value can be recorded as an expense in order to reduce the amount of taxable income. This can be applied on things such as plant, tools, vehicles, computers, furniture and buildings. We may also be asked a question on our understanding of the term overheads, and to address this we can say that overheads means the operating costs of the business that are incurred on an ongoing basis. Overheads can be both fixed or variable. For example, fixed overheads could take the form of rent on office buildings or building insurance costs that do not change each month, whereas variable overheads tend to fluctuate depending on the activity of the business, for example delivery or utility charges. The next question we'll take a look at is what is an escrow account? And to address this, we can say that escrow accounts are contractual agreements that are used as financial instruments within a transaction. The asset or currency being transferred between two primary parties is held by an intermediary third party. The currency being exchanged is held by the third party until each of the two primary parties have met their contractual obligations, allowing the money to then be transferred. This is often used by mortgage lenders when completing on the buying or selling of real estate being exchanged. The next question we'll take a look at is please name the three different types of accounting ratios. And to address this, we could first of all reference liquidity ratios, and these consider an organisation's ability to pay their debt obligations and assess its margin of safety by looking at the number of metrics including their operating costs against short-term debts. We could also make reference to profitability ratios, which assess an organisation's ability to generate profits from its sales operations and shareholding equity. The ratio indicates how efficiently a company is generating its profit. And finally, we need to mention gearing ratios, which compare capital within the company against its debts, and the gearing is a measure of a company's financial leverage and sets out what proportion of the firm's activities are funded by shareholders versus its creditor funds. We may also be asked a high-level question on our understanding of why businesses need to keep company accounts, and to address this we can say that they are used to record and measure a company's profitability. We can also say that they're there to assist with tax calculation, including calculating any taxable deductions. We'd need to say that legislation often requires companies to keep accurate accounts, and they're also there to support business growth by identifying profitable operations whilst also allowing management to minimise any loss-making activities. The next question we'll take a look at is what is financial leverage? And to address this, we can say that financial leverage is a concept of using borrowed funds in the form of debt to enhance business operations and increase the company's profitability and rates of return. In the event that the rate of return invested via borrowed funds is higher than the interest on those funds, then more profit can be generated in the concept of financial leverage. The next question we'll take a look at is what are capital allowances? And to address this, we can say that capital allowances allow taxpayers to gain tax relief by using their expenditure to be deducted from their taxable income. But we should note that the expenditure used to lower taxable income is only allowed within certain categories of costs. For example, plant and machinery, integral parts of structures and buildings, for example lifts and escalators, research and development costs, and the cost of obtaining any patents. And the next question we'll take a look at is what is the difference between a current asset versus a fixed asset? And to address this, we can say that current assets can normally be converted into cash within one financial year and are regarded as assets that allow day-to-day operations of the business to continue. Examples may include any money owed to the company following sales of its products or services, inventory and prepaid expenses, whereas fixed assets typically cannot be converted into cash within 1 year, and these kind of assets are recorded on a company's balance sheet as fixed assets that the company owns on a long-term basis. For example, any vehicles, office furniture, machinery, buildings and land. What is the difference between a profit and loss account and a balance sheet? And to address this, we can say that a profit and loss account shows the incomes and expenditure of a company and the resulting profit or loss, whereas a balance sheet shows what a company owns, its assets, and what it owes, also known as its liabilities, at any given point in time. We may also be asked a question on what the key financial statements are that all companies must provide, and to address this, we can say that these consist of a profit and loss account, the balance sheet, and cash flow statements. We may also be asked a follow-on question to this, asking what is a cash flow statement? And to address this, we can say that this consists of the summary of actual or anticipated ingoing and outgoing of cash in a firm over the accounting period, and it is broken down into operating, investing, and financing activities. It measures the short-term ability of a company to pay off its debts, and here is an extract of a typical cash flow forecast. The next question we'll take a look at is, why do chartered surveyors need to be able to understand and interpret company accounts? And to address this, we can say first of all that this is needed for reviewing their own firm's accounts. It could also be for assessing the financial strength of contractors and those tendering for contracts. And it could also be for reviewing profitability and sustainability. The next question we'll take a look at is, what is the purpose of a profit and loss account? And to address this, we can say that this is to monitor and measure the profit or loss, and it can also be used to compare against past performance, compared to the budget, and compared to other businesses. It can be used in assisting and forecasting future performance for the next budgeted period, and it can also be used for calculating taxation. We may also be asked a question on the difference between debtors and creditors. And to address this, we can say that first of all, creditors are entities or businesses that your firm owes money to. For example, if a subconsultant's fees are still outstanding, then they would be a creditor of your firm. Whereas debtors are entities that owe money to your own firm. For example, if a client has an outstanding balance of fees that still needs to be paid, then that client would be a debtor. We may also be asked a question on what are financial statements, or our understanding of financial statements. And to address this, we can say that these are forecasts of any income and expenditure, and these can be used as an analytical tool to identify potential shortfalls and surpluses of working capital. Another follow-on question we may be asked is testing our knowledge of profit and loss accounts. And to address this, we can say that profit and loss accounts show essentially the sales and expenditure of a company over a financial reporting period. So it'll basically compare the sales versus the expenditure of a company, and this can then demonstrate any profitable or non-profitable activities the company is undertaking. Again, staying with the topic of financial reports, we may also get asked a question on our understanding of balance sheets. And to address this, we can simply say that balance sheets show the value of the company. So they demonstrate everything that the company owns, for example, its assets. They also show anything that the company owes, also known as its liabilities. And this will show the value of the business at any given point in time. Again, staying with this topic, we may also get asked a question on what are the key indicators or signs of insolvency within company accounts. And this could include indicators such as a low credit rating, a current ratio below 0.75, and also a falling in working capital ratio, which would suggest that the company has taken on more contracts than it can finance.